Why angel investors are not going to save you.
So we're talking about angels and angel investors today.
We are. So as we all know, and this isn't exclusive to Alabama, but this is where we are. And I think of a lot of ecosystems can probably tune into this and get some learnings because you can probably relate to the conversations that we're going to have. But everyone keeps asking why Alabama doesn't have more early stage investors. And I think a simplistic response to that is, well, they don't want to invest. I think that's myopic. I think there is some layered reasons as to why. And instead of recycling those usual answers, we're going to keep asking the question. We're going to keep asking why until we get to something real. So for this episode, you're going to need your skepticism, and your optimism as we explore what the answer for this is and how we can change it and how founders should position themselves. So Matt, first, let's define, because the goalpost has moved, what is an angel investor?
It's a great question. Originally, angel investors typically were successful people in their own space. Maybe they were founders that had an exit. Maybe they were successful entrepreneurs and a traditional legacy business that then would take a small amount of money and invest with a founder that was the next generation of founders. And they had a lot of reasons for doing that. But one of the things that always made an angel investor, quote unquote, an angel investor was there was no expectation they were ever going to see that money back.
Right.
So in kind of true, I guess, an angel persona, it's, that's really, gracious. Give me this money. You'll never see it again. And you're okay with that. Now, that's kind of evolved over time to be more emblematic of small investors. So investors that are just writing checks, let's say 5,000, 10,000, maybe up to 50,000 in some of the bigger markets. But in general, we now talk about angels as kind of small investors, and angel investors are interchangeable. But originally it was kind of more of that persona of, I'm going to invest in the next round or the next generation of founders, and I don't expect to get any of the money back.
Yeah. So then what's the incentive? What's the incentive to be an angel investor? If by definition, what you just gave us, the expectation historically has been, I'm probably not going to see this money come back to me. So then what is the motivation to do it at all?
Yeah. I mean, I think there's a couple of different things. I'll use the example of MITCH KAPOR because it's probably the best example of a true angel investor that worked out. So MITCH KAPOR, if you're not familiar with him, was one of the co-creators of the Lotus suite of software products. And you're just glazed over because you're like, I have no idea what you're talking about because I'm old and you're not.
I'm here to learn.
And so think of it this way. Lotus Notes was the first kind of version of a word processor before Microsoft Word was ubiquitous.
Sounds vintage, but continue.
Yeah. And then Lotus 123, I think is what it was called. I'm going to get fact checked in the comments on this, but that's okay. Was the first version of a spreadsheet. So Excel before it was Excel.
Wait, there was an Excel before an Excel.
Yes, there was a spreadsheet before Excel. So MITCH KAPOR was one of the co-founders of Lotus. They created those things. They did very well, and then they eventually sold that company. And it escapes me who bought it, and that's also going to get roasted in the comments. Doesn't matter. The point is that's kind of where he made his money. So he decided to start doing some angel investing, and in true angel investing fashion, MITCH went out and found a bunch of promising founders and wrote a bunch of small checks. One of those small checks that he wrote was to Travis Kalanick, who is the founder of Uber. And you can imagine that 95, maybe only 90, but 95% of those checks went nowhere. He never got his money back. They went to zero, or he got a gee, thanks, we tried, but it didn't work.
Right.
The Uber investment as an angel investor really demonstrated that power law. And that in simplest terms is the very few investments will provide the overwhelming amount of return to any investor, whether that's in a fund structure or just as an individual. It's just the way it plays. Right. And that happened for him and that Uber investment because he had about an 8,000% return on his Uber investment for the $70,000 or whatever it was by the time it went public. Now, he held that position as a shareholder for, I'm guessing, 9 years, 12 years before it became a public company and he was able to liquidate. So that's the obvious one, which is some of these work out.
Right.
The other reasons, maybe more importantly and more generally, is maybe it's a legacy thing. Maybe you just think you should do it. Maybe you just like the asset class and you have a certain amount of capital you're willing to risk at the most extreme kind of risk tolerance or lack thereof, or I should say the most risk tolerance that you have, and just saying, I like this, the old saying, I like your shoes, I hope you win.
Yeah.
It could be that, it could be a bunch of things. But in the best case scenario is what happens with somebody like MITCH KAPOR.
Okay. So now that we have a working definition and we have an example as to what incentivizes a person to make an angel investment when there's a high risk to lose, then bringing it back down and applying it, how does angel investment impact ecosystems like Alabama, these ecosystems that aren't bookending the country? Yeah,
I think the probably most important role they play is they're the first risk capital for a lot of those ecosystems. You know this, but they can't, a startup founder can't go out and get a loan from a bank.
Right.
They're probably already maxed out their credit cards. If they could bootstrap it, they would. And so they need these early, high risk tolerant investors that we're calling angels to come in and give them that $5,000, $10,000, $50,000 check so that they can get going. It probably is the only way that a lot of those companies get started if they don't naturally have money from a previous exit or they're not, independently wealthy themselves. So it's very catalytic, and it's some of the only risk capital available in smaller ecosystems.
So we don't have a lot of angel investors. Why?
That's a loaded question. I think there are a bunch of reasons. Total population. I mean, just the math of it.
Number issue.
I mean, we have 4 million people in the entire state of Alabama. And then we probably also have a very low percentage of participation even in that 4 million. And so I think that there's just a math issue. The number of incredibly high net worth individuals is fairly limited. We have 2 Fortune 500 companies in the entire state. And the only reason I bring that up is Fortune 500 companies tend to have wealthy executives. And those wealthy executives would fit that profile of being an angel investor. And we just don't have that many big companies. I also think that there's a lack of culture around it. It's just not a thing that people do here. And again, that may go back to the population. It may go back to the participation rate. I don't know, but they just don't do it. I also think that that's partially because entrepreneurship in Alabama has been more of the kind of traditional legacy style of entrepreneurship and not necessarily tech and startups. So you saw people who would go out and they would effectively get a bank loan, or they would have some family money or some pocket of cash available to them somehow, some way. And then they would slowly build over time, but they weren't going out and trying to find, $1.5 million to build a fast scaling software company in Montgomery, Alabama. That just wasn't the way that entrepreneurship here worked. And so that idea of startups and high growth tech startups and cash burning high tech startups, high growth startups, just hasn't been a thing until probably the last 20 years. And people will hear that and go, well, 20 years is a long time. It's not when you think about how startup ecosystems work. That's part of it. The last part of it is we don't have a significant number of those successful founders with exits that are now participating as angel investors and kind of supporting that next generation of founders yet. We have a handful. They are active. But again, it goes back to that population and that participation percentage. Most of our successful entrepreneurs immediately launch something else. And so they're risking their capital on their next thing. So their amount of risk capital is limited because they're plowing back, and good for them. They should. I'm excited about that. They're going to create some good economic outcomes for the state by doing that. But I think all of those things kind of come into play with, which just goes around that culture. Right?
Yeah.
We don't have the population, and we don't really have the culture around it.
There's a thread I want to pull on because you mentioned culture, and there can be culture, right? Then there's risk aversion, and some scar tissue from bad investments. Before we move on, I want to pause here. Can you speak to the type of mindset that you need to have if you decide to be an angel? And if you are planning to participate, what should you expect? Because that scar tissue, that bad, I'm not going to say bad investment, but that risk is always going to be there. So what are some signals that this may be a game that you want to play, essentially? Yeah,
I just got this question not long ago in a very public forum, and somebody said, well, how should I, if I want to put money into this, how should I do it? And my answer to him was don't. The percentage of the population that is in a position financially to be an angel investor is incredibly low. But let's just say for a second that you are, and what I mean by that is, financially you're well taken care of. The next generation is taken care of. Maybe the generation after that is taken care of, and so you're in the unique position to make some of these high risk bets. The first thing is don't put all of your eggs in one basket. That goes back to your point about scar tissue. Too many angels will go and they'll make one bet on one company, and it goes south. Because the law of percentages say it's going to go south. And then once they get burned by that, they're like, well, I tried it. It didn't work. I don't like it. Right. As opposed to saying, hey, how do I figure out how to take the $150,000 total I'm willing to risk, and how do I spread that around to 10 different companies or at least 7 different companies or something? And that just goes down to pooling your risk. That just goes back to diversifying that risk. All of the kind of basic tenets of any investment, not just private investing or startup investing. And so I think a lot of people get that wrong. They see one thing and they go after it. The other thing too is that angel investors often don't invest in things they understand. And that's a big problem. So I'm going to sound like Warren Buffett here for a second, but his big thing was, I don't invest in things I don't understand. And Berkshire Hathaway's entire investment history, he can tell you exactly how a business works, and he understands how the business works, he understands the market it works in, or he doesn't invest in it. It's just that simple. And I think sometimes angels get enamored with the founder, or they get enamored with the idea, or they really think that market segment is hot, and so they go, well, I'm going to go all in on this one, or I'm going to over-index on a single bet as opposed to spreading that risk around. And I think that's where we get a lot of it wrong. And once you get burned, you're not as interested in trying, touching the hot stove again.
Yeah. Let me ask you this, and this is veering a bit off, but we're talking about, you mentioned that gentleman asked you, okay, how can I get into this game, right? And you were like, you said, don't. Fair. Is there a place for folks who may not be generationally wealthy, but they've done well for themselves, they have a bit of margin to write smaller checks? How can we and other ecosystems who are in our position leverage folks like that to write checks and be angels versus, or as we wait on the rest of the systemic infrastructure to, become more concrete? What can we do now with the folks who want to actively participate? Is there a vehicle or a way for people to do that?
There are some national ones. There's a Fundrise, I think, is one, but you're going to be investing as an LP in random stuff and at a very, very small percentage. So it's not like you're going to be investing in things that you care about directly.
Okay.
You're just going to be a participant. It basically allows you to participate in funds you wouldn't normally be allowed to invest in or provided the opportunity to invest in. I think the real path forward is likely if you are financially in a place to participate as an angel investor, you probably move in circles with other people who are in a position to be angel investors. And my advice to them is always the same, which is find 5 or 6 other families, 5 or 6 other individuals that are also interested in investing in the same kinds of things that you want to invest in, and then pool it together. And so nobody is risking any more than a certain amount of money. And that pooled vehicle, whether it's an LLC or a special purpose vehicle is the technical accounting term for it, SPV, you get to go and invest in a lot of different things, spread that around. So let's say, for example, I want to totally risk, at most, I want to risk $100,000. Well, if I find 4 other people in the same kind of risk tolerance and same kind of attitude, well, now I got $500,000 as an investment vehicle, and I'm not going to write a $500,000 check into a single entity.
Yeah.
I'm probably going to go try to find $10,000, $50,000 opportunities. And at any point in time, each individual investor into that pool, into that SPV, that LLC, is then taking an even smaller percentage of risk by dollar amount.
Yeah.
Same percentage, but dollar amount. And they get to be in more things for less money, and they get to invest in things that they really care about or they want to invest in. And so it's a lot easier to get 5 people on the same page about what you want to invest in than it is to, get 100 people or be an LP in one of these huge funds where you have no say at all.
Right. So can you talk a little bit about how have other states essentially busted out of these constraints? What does that look like in other places?
Yeah, I think there's 2 big drivers. One is that you have startups that have exits and meaningful exits. So let's say 500 million to $1 billion, right, in exits. That creates some liquidity for a lot of people pretty far through the organization. So it's not necessarily just the founder, but the founder, the C-suite, the director level, manager level, et cetera, can walk out of there with a little bit of money. Those folks then finding opportunities to invest as angels is one of, historically speaking, is one of the most common. So if you look at areas like Austin, Texas, Boulder, Colorado, even places like Cincinnati, Ohio, which may surprise some people, those had big exits from major for major exits from startups, that those founders and those executives then started angel investing in the next generation or the next early stage companies that were around, of founders they knew, or even founders that came from their company, exited and started their own thing.
Right.
That's really common. So that's one. And the other one is, when you have those big exits, it does create a little bit of a FOMO where all of a sudden people who were kind of sitting on the sidelines go, geez, I had an opportunity. I know that person. I know that founder. I knew them in high school, right? Or I knew their folks. And I probably had an opportunity to put in $25,000, $30,000, $50,000.
Yeah.
And what would it be worth now? And so people start thinking in that way. And then all of a sudden you get this kind of a little bit of a lift. Now that's short term. That doesn't usually last. And frankly speaking, people get into those things and then are kind of upset that they did, because they don't realize the duration that it's going to take for them to get their money back.
Right.
But those are 2 of the most common ways you typically see kind of the culture, for lack of a better term, in angel investing start to develop.
I would love to hear you share a little bit for folks who may have not heard that this incentive exists, but the tax incentive to folks who are investors. Can you just talk a little bit about that? I know it's available in other states. I don't think we do that here in Alabama, but incentivizing and giving tax breaks to folks who decide to be angels. I know it can be controversial, but can you just give the people a high level overview of how systemically other states have been able to remove some constraints?
Yeah, well, I mean, I will say this. If you're an investor in general and you have a return from it, your taxation is treated as capital gains, which has a lower taxation rate than regular income. So there's just a general benefit in that, same as you would for any kind of publicly traded stock.
Yeah.
I'll use Wisconsin's example of their program, and I don't know the name of it. Apologize to anybody in Wisconsin. Love your state, by the way. Big fan.
And cheese.
Big
cheese,
fan.
right?
Big fan. But having said that, they have a program which basically startups go and they qualify as what are called QBRs. And they're basically qualified business investments. And then any investor, whether it's an angel investor, it's a fund, it's in-state, out-of-state, whatever the case may be, they can invest in that company, and then whatever tax liability proceeds from that investment create in the state of Wisconsin are waived. So effectively, if it creates a tax event in the state of Wisconsin, then they waive that for those investors. And it's a program that they've been running for, I think, more than 10 years now. and they'll tout billions of dollars worth of economic impact in just having that program. And if you look at the people who are the qualified funds, because you have the qualified businesses, then you have qualified funds on that, you look at it, it's a fairly impressive list. It's like a who's list. You would recognize the names of some of these VC firms.
Okay. That's always been interesting to me. Another thing that has been interesting to me, which is very difficult for me to wrap my head around, Alabama is a philanthropic state. Birmingham is constantly rated as one of the most philanthropic cities in the nation. Help me understand the what makes us or folks give their money to nonprofits, right? Foundations. You will not see a return, at least not financially. You may see one socially. Versus putting their money somewhere where they may not see a return or they may see a return. My theory is it's more tied to legacy, right? If your family gave to an organization, then there's an expectation that you continue that tradition. I think it's also a social signal as well, a broadly understood social signal, like having your family's name on a building. We understand that is a signal of wealth and prestige. Or having a permanent seat on the board. We understand that is a signal of wealth and prestige. And there's, at least in our community, not a lot of association with that when it comes to startups, at least not broadly. But I just like to hear your theories about that. We're very philanthropic, but there's no return. So how can we turn that shift and tell the story of this is also a very worthwhile way to diversify, like and to allocate your capital? Yeah,
I mean, I would go back to I agree with all of those things. I think it's legacy. I think it's a culture around it. I think there's a family expectation,
right,
that every generation that preceded mine did this, so therefore we're going to do it as well. People like their name on plaques.
Yeah.
People like their names on buildings. People like to point at stuff and go, we built that, or we helped to build that, or we funded those things. And that's really important. And Alabama has benefited tremendously from that generosity, from that charitable culture that is here. I've never lived anywhere that had that kind of per capita amount of charity built into expectations for themselves, or for that people have of themselves. And it's inspiring, to say the least. Now, having said that, the other reason that people typically will, donate or support financially an organization or a place is that it's trying to generate some sort of positive outcome. Maybe that's a cultural outcome. Maybe that's an impact outcome. Maybe it's some access issue, whatever the case may be.
Right.
So if I looked at, for example, somebody that wants to donate to Future Farmers of America, the whole point of that organization is to literally create the next generation of farmers for the United States, for that industry, for our economy, and frankly speaking, for our food supply.
Right.
I could make the argument that if you were to say, instead of giving $100,000 to Future Farmers of America, but you were instead splitting that $50,000 to Future Farmers of America and $50,000 to an accelerator program that supports ag tech founders and ag tech company startups.
Right.
You may be able to create as much, if not more, impact by supporting that startup in ag tech that is working on improving yield for crops, or decreasing disease, or improving disease resistance, or minimizing the amount of irrigation required for a certain crop, maximizing, some other output. One of the big issues right now is just succession planning in agriculture. Dairy farmer kids don't want to be dairy farmers.
Yeah.
Right?
Yeah.
They've never been on a vacation in their entire life.
Yeah.
So if you have a piece of software that makes them more productive, more efficient, takes less time, gives them more of their lifestyle back outside of having to be up at 4:30 in the morning every morning to make sure that the cows get milked, that is something that creates some sustainability in that industry.
Right.
So I would argue that's a huge impact. And oh, by the way, Where I can guarantee you're never going to get your money back or see a return financially on that philanthropy. You have some percentage, even if it's a small percentage, chance of having that capital returned back to you.
Right.
Now, if that makes people feel icky, right? Like I'm being a capitalist while trying to have social impact. Think of it in the broader term, which is when that capital gets returned back to you, then you can donate it if you so choose, or you can reinvest it in the next startup to see if you can go and support that next innovation, that next founder who wants to support that industry or make that industry better. So I think there's a way to look at it to say, hey, I could do both. It's not a zero-sum game, which I do think is a trap that a lot of people fall into. And it limits how many people are willing to do those things. So if they wanted to invest in ag tech, like I mentioned, or digital health or health tech, those innovations are often creating some of the same impact that you're philanthropically trying to drive through these organizations. So my argument is you can end up with the same or better outcomes being an angel investor into those kinds of things than you would necessarily just being philanthropic.
Yeah, I agree with you. Particularly what you mentioned about if you're going to be investing, you're giving to these philanthropic causes that are addressing the symptoms of these wicked problems like agriculture, healthcare. I think doing some value-based investing, if you really want to turn the tide and make systemic change, going up the chain and investing in companies that are addressing the root cause of the issue and not the symptoms that we experience every day. I mean, to me, that's, to your point, the opportunity. You mentioned education. Is there a larger opportunity to educate those who might be interested in angel investing?
In a larger sense, I really wish there were more kind of angel clubs that were truly focused on educating their members around the opportunities in angel investing, what that really looks like, the pitfalls of that, very, full-eyed, optimistic, but also realistic about what you're getting into. And that education specifically to drive actual increase in investing in your local area or in the marketplace that is important to that club or that organization or its members. It's not enough just to get a bunch of people together and talk about investing, because that's a trap that we see people fall into often. They'll start these venture capital clubs or investment clubs or angel networks and all those things. And really it's an excuse for once a month you get together at somebody's house or at the country club and you talk about something cool that happened in Silicon Valley and you have a couple of drinks and maybe some heavy hors d'oeuvres. Everybody talks like an investor and then goes home without actually committing any investment capital to anything. And so you fall into this social trap of what an investment club needs to be.
We're all rich here.
Yeah, so I'm already wealthy. Why would I risk my capital? But this is super fun to talk about what Facebook is doing or Meta is doing or whatever they call themselves now. I think that if we had clubs that were, the whole point of it is we're here to educate, but that education is going to create an output, and that output looks like more investing. Yeah,
it's funny you mentioned that. I've been thinking a lot about, just as someone who's interested in eventually angel investing, a place to go to get educated on the realistic aspects of angel investing, but also there are deals in front of me that make sense and make local impact, and particularly early stage deals that make sense and for local impact. So I totally agree with that. The fact of the matter is we don't have a lot of angel investors. And with that limited number, a lot of founders don't know where to go, or even if you're from here, don't know how to get in front of these folks. So, I mean, what's your response to that?
Sometimes you got to kick down the door.
Yeah.
I wish there was a more elegant answer, but access is continuing to be an issue for anybody who didn't grow up with the kind of social, family, or even professional networks around high net worth individuals or investment capital.
Yeah.
And so angel investing in, Birmingham, for example, and I think it's true throughout the state, can feel very clubby around, and that terminology is from country clubs, right or wrong. And that basically says, like, if you're a member of a country club or your family's a member of a country club, you probably have access that other people don't have. And so breaking those doors down has been a generational problem, and I don't know that anybody's necessarily solved for it other than see above the idea of having these higher profile angel investing clubs where people are actually committed to investing. That's a good way to create access that normally is, behind the gates, right? Or behind the rope, that you may or may not have access to as a young founder. Certainly if you don't come from that background or you don't have that network kind of baked in, very difficult. So having some, publicly facing organizations that are saying, hey, we're really trying to put more money towards early stage startups. That's a good one. I use this term a lot, but Anthony Hood here in town said this years ago, and I've stolen it, 36 times. Always quoting him though. He said, part of our problem is we don't show them the front door. And he means that access to customer opportunities, to be a vendor for a larger company, to find investors, to all those things. We have to do a better job of showing them the front door. Those investment clubs, if they're publicly facing to a degree, could certainly be one opportunity to do just that, to improve that access.
Yeah, I really believe that SPVs and just average folks who've done well for themselves and have some margin getting together and investing together is one of the ways that we're going to move this ball. One, I'm just biased against not asking for permission, right? But I think there are more folks who fall into that category than the aforementioned categories. And so that's where the real opportunity is. So, list of takeaways, action items on this topic, what would they be? Yeah,
for me, it would be understand the local culture, understand where you are in all of that. Because if you think you can do, if you're thinking about your business model and your startup being, I need this angel investor, or I need a certain amount of angel investment, or I need this early stage capital because I can't get a loan, or I can't bootstrap this. I can't finance this myself. I need these things. You better understand what that landscape looks like, and you better also understand what your access looks like. So that's job number one. For the larger ecosystem, the takeaway is, how are you creating, if you are of means, if you are in a position to invest as an angel, if you have friends that are in a position to do that, what are you doing about it, right? If you're not interested in doing this, God bless you, right? Go do other things, buy mutual funds, right? Put your money under the mattress. That's totally up to you and totally understandable if that's what you want to do. But if you genuinely want to invest in this space and you want to move this needle for that ecosystem, take some steps to make that happen. Start it with, do I have 3 or 4 or 5 other people that are interested in doing this? It doesn't have to be complicated. You commit to a number, you commit to how many investments over what period of time you want to make. You set up a basic LLC for, $175 on whatever it is, Rocket Law or whatever version of it is that set up an LLC for you for $100 or whatever it is. And then just start doing it. I think it's just that simple. Understand the opportunity, understand what role you want to play in that opportunity, and go do it. Well, that's the end of this episode. Thanks for checking us out. Please remember to like and subscribe so we can feed the hungry algorithm.